What happens when the lifeblood of innovation suddenly disappears? For decades, Silicon Valley Bank was the engine fueling the tech world. Startups, venture capitalists, and dreamers all relied on its lifeline. But in a matter of days, billions vanished, leaving founders scrambling, employees panicking, and the financial world stunned. How could a single bank, one of the most trusted in the tech ecosystem, collapse overnight? What does this reveal about modern banking, risk, and the fragile foundations of our financial systems? This is not just a story about money, it's a story about trust, ambition, and the delicate balance that keeps the modern economy alive. To understand the collapse, we must first understand the world SVB thrived in. Founded in 1983, Silicon Valley Bank SVB quickly became the heartbeat of the technology ecosystem. Unlike traditional banks, SVB specialized in lending to startups, companies that often had no revenue, no collateral, and a dream. It wasn't just a bank, it was a financial partner offering loans, deposits, and venture capital connections. To tech founders, SVB wasn't a bank, it was a promise. We understand you, we're on your side. During the 2010s, SVB's growth mirrored the tech boom. As unicorns emerged and venture capital flowed, SVB became the bank of choice for the innovation economy. It handled the deposits of tens of thousands of startups, managing billions of dollars in venture capital inflows. But behind the glossy veneer of innovation, risk was piling up. SVB's model was simple yet risky. It took deposits from startups which often sat idle and invested them in long-term government and corporate bonds. During a low-interest rate era, these investments seemed safe. But bonds, like all financial instruments, carry risk, especially when interest rates rise. As the Federal Reserve began hiking rates in response to inflation in 2022 and 2023, the value of SVB's bond portfolio began to shrink. This wasn't obvious to most depositors. On paper, SVB appeared sound. In reality, the bank was sitting on a time bomb. The first warning signs appeared quietly. Startups started drawing down their deposits to cover payrolls and operational costs amid a tech funding slowdown. In the weeks leading up to the collapse, SVB sold a large chunk of its bond holdings at a loss to raise cash, a desperate attempt to meet withdrawal demands. The sale triggered alarm bells. Investors realized the bank was not as liquid as it claimed. Rumors spread like wildfire SVB might fail. In the world of finance, perception is reality, fear becomes contagious, and suddenly depositors rush to withdraw their money. In banking, this is known as a bank run, a scenario SVB had never anticipated could happen in the modern tech-driven world. On March 10, 2023, Silicon Valley Bank made the announcement. It had sold securities at a significant loss and was planning a capital raise. The response was immediate and catastrophic. In a matter of hours, depositors flooded the bank with withdrawal requests. The digital age accelerated the panic. Social media posts, news alerts, and Slack messages spread fear faster than ever. By March 12th, the California Department of Financial Protection and Innovation closed SVB and placed it under the control of the Federal Deposit Insurance Corporation, FDIC. Billions evaporated. Startups scrambled to secure payroll. Venture funds froze capital calls. The tech ecosystem, which had depended on SVB for decades, was suddenly in limbo. The SVB collapse sent shockwaves far beyond Silicon Valley. Startups faced payroll crises. Companies had funds trapped in SVB accounts, threatening layoffs. Venture capital uncertainty, investors hesitated to deploy new funds, global market jitters, bank stocks fell worldwide as fears of contagion spread. Even the Federal Reserve and Treasury had to intervene quickly to reassure depositors and prevent panic from spreading. SVB's collapse became a modern example of systemic risk, a reminder that even specialized institutions can threaten larger financial stability. After the collapse, regulators acted fast. The FDIC guaranteed deposits above the insured limit to prevent further chaos. Federal Reserve liquidity measures were deployed to stabilize the banking system. But these measures were reactionary, not preventative. Many critics argued that SVB's unique client base, startups with large deposits above FDIC limits, should have been monitored more closely. This collapse also exposed gaps in banking oversight for niche financial institutions and highlighted how modern tech ecosystems depend heavily on a few specialized banks. The SVB crisis is not unique in history. 2008, financial crisis, banks overexposed to risky assets collapsed, creating systemic panic. 1980s savings and loan crisis, poorly regulated institutions failed amid changing interest rates. Dot-com bubble, tech investments collapsed, showing the volatility of the innovation economy. SVB's collapse demonstrates a repeating pattern in finance. High growth plus concentration of risk plus poor risk management equals crisis. The modern twist is speed. In 2023, information and panic travel faster than ever, causing crises to unfold in days instead of months. Diversification matters. Relying on a single institution for critical financial needs is risky even if it's trusted. Interest rate risk is real. Long-term investments in low-yield assets can become dangerous in rising rate environments. Systemic risk is evolving. Tech-driven economies are interconnected, meaning a collapse in one niche can ripple globally. The SVB collapse is a warning to founders, investors, and regulators. The modern banking ecosystem is fragile. Technology may accelerate innovation, but it also accelerates risk and panic. The question remains, which other banks are exposed to similar risks in this fast-moving, digital-first economy? If you want to understand how tech, finance, and risk intersect in the modern world, subscribe to this channel. Turn on notifications to get updates on the latest economic crises, bank collapses, and financial trends that could impact your money and the global economy. The collapse of SVB isn't just history, it's a lesson for everyone who relies on the modern financial system.